This economy is confusing. According to some, this is the strongest economy of all time.
I know what it took to take our economy from the depths of the pandemic to where it is today, the strongest economy in the world.
But not everybody agrees.
But inflation's killing our country. It is absolutely killing us.
That's why today I want to cut through the politics, cut through the emotions, and focus on the finances. That way you can be a smarter investor by going over 5 things. Number 1, I want to give a real update, not a political update, a real financial update as to what's happening with our economy right now. Number 2, I want to go over why we're seeing a slowing in our economy. Number 3, I want to go over what's going on with inflation and interest rates and what might be coming. Number 4, I want to go over what's going on with the government debt, some things you might want to be concerned about. And number 5 is I want to talk about how this can create opportunity for you as a financially savvy investor. You don't want to miss this part. So let me start by talking about number 1. What's going on with our economy right now? Our economy today is the largest that it's ever been. But the size of the economy isn't really what matters. It's how fast the economy is growing, because that's going to then hopefully translate to how much money you're making and how much wealth you get to build. If we go back to 2021, we saw that the economy was growing at record-breaking speeds. But today, as we're in the second half of 2024, it's a very different story with our economy now officially slowing down. This naturally has some people wondering if we're in a recession right now, and the best way to explain this is to understand, well, what is a recession? A recession is when you have 2 consecutive quarters of negative GDP growth. In other words, you're in a recession when you see the economy shrink for 6 consecutive months. Based on the data that we have today, the economy is not shrinking. It's just growing slower than it was before. It's kind of like the difference between inflation, deflation, and disinflation. Inflation is when the prices of things are growing. Deflation is when the price of things are falling, and disinflation is when the prices of things are just not growing as fast as they were before. But I'll explain more about that in just a minute. The size of our economy is measured by a number called GDP, which is this chart that I showed you here, which is essentially just the sum of all the spending that happens in our economy. Right now, our economy is slowing. That means it's not shrinking, it's just growing slower than it was before. Now, some of you might be saying, well, Jaspreet, I think that we're in a recession today. Well, you got to understand that our economic data is often revised backwards. Meaning, if 4 months from now, the economists realize that our economy was actually slowing right now in 2024, well, then they can backtrack this data and say that the recession started sooner, but that's not what we're seeing today. Based off of the data today, our economy is growing, just not as fast as it was before. This brings me to part 2 of this video, which is why is the economy slowing down now in the second half of 2024? And if you've been reading market briefs, you already have an idea of this, but I want to dive a little bit deeper, because through the beginning part of 2024, Americans were spending money like crazy. And the reason why this spending really confused economists is because on the same side, you also had a lot of people talking about how they were struggling to find a good paying job. Now, if you remember what I said just a couple of minutes ago, our economy, or GDP, is a measure of spending. The more money you spend, the more money somebody else makes. So when people spend money, that's what grows the economy. If you're not spending money, then the economy is not growing. So how were people still able to spend so much money despite the high inflation, despite the high interest rates, despite the fact that people didn't have good jobs? How are people still able to spend so much money? And this is where many Americans got creative. Over the last few years, as home prices boomed, people used it as an opportunity to pull cash out of their home through a cash out refinance, so they had more money to spend. A record number of Americans pulled money out of their 401ks using a hardship withdrawal. That way they had more money to maintain their lifestyles. Credit card debt has been exploding at some of the fastest rates we've ever seen in the history of America. And not surprisingly, you just have a lot of people digging into their savings or saving less money. This is where things get very interesting, because all of this news is great news to the economy, because that means more spending is happening even if you can't afford it, but it's bad news for people and consumers, because that means you're spending money you don't have, you're going into debt, and you're digging into your life savings to maintain your lifestyle when you can't afford to do so. But this is where I want you to take a look at the changing trends of what's happening with spending, because in the second half of 2024, we immediately are now starting to see a little shift in the way that people are reporting on the way that Americans are spending money in America. Now, we've been covering this in market briefs Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in the economy and the housing market and the stock market and crypto and the global economy. It's a fun reading, easy to read newsletter. So if you're an investor and you want to stay up to date on what's happening, when it's happening, this is a free resource for you that I guarantee you will love. And how can I guarantee it? Well, because if you don't love it, you can unsubscribe at any time because it's completely free. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. Now take a look at how spending habits have changed, because up until just a few months ago, the news always said that Americans are always finding a way to keep spending money despite the craziness in the economy. But now, for the first time in years, we're seeing a trend of Americans looking for discounts, people looking for ways to save money, people looking for ways to spend less money. Now I know I'm no economist, I'm not a financial advisor, but what this signals to me as a random guy on YouTube is that it seems like this inflation and the higher interest rates are finally starting to burn a hole in the American people's pockets, to the point where people are saying, I can't keep affording the same lifestyle that I had before. Sure, maybe before I could have easily accessed some more debt, but now with the higher interest rates, now with wages where they are, I can't keep spending the way that I could before. And this brings us to point number 3. Who said finance couldn't be fun? Point number 3 is what's going on with inflation and interest rates right now. A few moments ago, I talked about how our economy was growing at some of the fastest rates we've ever seen in 2021. And the reason why we saw this big boom in our economy was because of inflation. Let me show you what I mean. Back in 2022, our economy was about $25 trillion big. And during the pandemic times, the United States government stimulated our economy by $5 trillion. Now, I want you to kind of conceptualize this for a second. If our economy is $25 trillion big, meaning it takes 365 days of every company in America and every citizen in America working hard for a whole year to produce $25 trillion worth of wealth, and then the United States government works with the Federal Reserve Bank to push a few buttons to print $5 trillion, and then they inject this money into the economy to stimulate the economy. I mean, they just grew the economy by 20% in a matter of minutes through clicking a few buttons. What is that going to do? If you inject all this money into the economy, you give it to the hands of people through unemployment checks, through stimulus checks, you give it to businesses in the form of grants and bailouts and PPP loans, what's going to happen? Well, spending is going to happen. And spending then influences the size of the economy. This then created the inflation problem that we have now, because what is inflation? Inflation comes from the word inflate. What are we inflating when we have inflation? We're inflating the monetary supply. We're inflating how much money is out there, because the government isn't sitting on a cash pile of $5 trillion. That's why the government is drowning in almost $35 trillion worth of national debt. It's because they keep spending money that they don't have. So in order for the government to spend this $5 trillion to stimulate the economy, they had to go deeper into debt to spend the money. And how did they get that money? Well, they partner with an entity called the Federal Reserve Bank, which is a central bank here in the United States. Now, not to get too into the weeds of what the Federal Reserve Bank is, just understand that the Federal Reserve Bank has the ability to influence interest rates, meaning they can raise interest rates, cut interest rates, and they also have the ability to essentially print money. I mean, they can create money and then lend it to the United States government. And so when the Federal Reserve Bank created this money, they gave it to the United States government. The government injected this money into the economy. It was great for the economy because the economy was booming, like we talked about. But then it created a side problem, which was inflation. As the government and the Fed created more money, the value of each individual dollar went down, then causing the price of things to go up. So now we had this inflation problem caused by the Federal Reserve Bank and the government, and that was when the Federal Reserve Bank started raising interest rates as a way then to fight the inflation problem. The whole reasoning behind this is as interest rates go up, you spend less money, because as interest rates go up, it's more expensive for you to buy a home, it's more expensive for you to finance a car, it's more expensive for you to finance things on your credit card, so you'll be less likely to do so. And if less people are buying cars, then you have less demand for cars, and then dealerships will stop raising the prices of cars. Likewise, if you have 50 offers for a home, then the home is going to sell for way over asking price. Versus if you only have 2 offers for that same home, it might not sell for over asking price. So this is where the Federal Reserve Bank was working to raise interest rates to cool inflation down by working to cool down demand, meaning they needed people to buy less stuff. Fast forward to today, and the high inflation is still around, and the Federal Reserve Bank says that they want to keep interest rates high until they can bring inflation down to their 2% target. So the Federal Reserve Bank is working to raise interest rates, that way they can cool down inflation. The problem is that interest rates went up and inflation went down, but it's not at the 2% mark that the Federal Reserve Bank wants. And the reason why this really matters for you is because inflation compounds. The inflation that we have in 2024 compounds on top of the high inflation that we had in 2023. The 2023 inflation compounds on top of the high inflation that we had in 2022. The high inflation that we had in 2022 compounds on top of the high inflation that we had in 2021. So now when the Federal Reserve Bank talks about we want to hit our 2% target, well, we still have this high inflation, which is compounding all the previous inflation that we've had, which might make you wonder, why does the Federal Reserve Bank want 2% inflation? Why don't they want 0% inflation? You know what? Why don't we want negative 5% inflation to bring the prices of things down to make up for all the high inflation that we've seen over the last 4 years? Well, let me let you in on a little secret here. The government and the Federal Reserve Bank absolutely do not want deflation, meaning they do not want to see the prices of things fall. Let me explain why here in point number 4, which is what's going on with this government debt that we have. The United States government has around $35 trillion worth of national debt. What does that mean? The government has borrowed $35 trillion. From who? They borrow this money from regular investors, people like you and me, people who have lent money to the government by buying what are called treasuries. These are loans made out to the government. The United States government also owes money to other countries like Japan and China. And the United States government has also borrowed trillions and trillions of dollars from the Federal Reserve Bank, who doesn't have money, they just have the ability to print money. So now that the United States government have this $35 trillion worth of national debt, they have to pay this money back plus interest. The reason why the Federal Reserve Bank and the government want something like 2% inflation as opposed to negative inflation or deflation is because if the government has all this debt they have to pay back, it's very expensive. But if the value of the debt falls, meaning if the value of the dollars that this debt is based behind falls, well, then it's less expensive to pay this debt back. I mean, $1,000 today is much less valuable than $1,000 30 years ago. Why? Because of inflation. So what that tells us is that a dollar today is more valuable than a dollar tomorrow or a dollar 10 years from now. This is why, for the government and the Federal Reserve Bank, inflation is good because that means they get to pay back the national debt with cheaper dollars. Deflation would mean that the government would have to pay back the national debt with more expensive dollars, which is not what they want. But if I'm being honest with you, that's not even the craziest part or the most concerning part that you need to understand. When the United States government has so much debt, the problem is that the interest payments on those debt have to be paid back. And how does the government get money? They get money from taxpayers through tax dollars. So you go to work and you get paid, you pay the government taxes, and then some of that taxes is being used to pay back interest as opposed to building bridges, as opposed to hiring police officers, as opposed to building the infrastructure that we need in this country. And the fastest growing expense that we are seeing in the United States today for the government is not our military, it's not Social Security, it's not Medicare, it's the net interest expense. In fact, in 2024, for the first time in the history of America, the government's interest expenses now are larger than Medicare, and it's even larger than our military expenses. That means the United States government is spending more tax dollars paying back its debt than it is to fund our entire military operations. And if that doesn't concern you, well, I just want you to think about, well, what's going to happen if the government keeps racking up debt at the rate that it does today? Because now our national debt and our interest expenses are the third largest expense for the United States government. This is why really the topic of taxes are important, not because of who's in power, Republican or Democrat. That's besides the point. The reason why taxes are important for you to understand from a financial perspective is because the United States government has one source of income, tax dollars through taxpayers. And then the United States government uses these tax dollars to go out and fund their expenses. Now, of course, the United States government spends more money than what they bring in, and then they fund this spending through debt or money printing through the Federal Reserve Bank. But if our interest expenses keep rising at the rate that they have, then we're not going to have enough tax dollars to pay off our interest expenses, let alone pay for everything else, which means it could be in our lifetimes that the government has to borrow money in order to pay back its debt. It's kind of like using your Visa to pay off your Amex. That could be a problem. But instead of harping on that, let's move on. Part 5, how does this create opportunity for you as an investor, as a financially educated person? There are 3 things that I want you to focus on. Number 1 is I want you to understand and build your financial education. Number 2 is I want you to understand the financial news. And number 3, I want you to understand the financial trends. When it comes to the financial education, what that means is number 1, you have to build your preparedness. Preparedness means you have cash. And you want to have cash for a couple of reasons. You want to have cash to protect you against an emergency. If you lose your job, something happens to your business, something happens in your family, you want money to fall back on. So if you don't have any savings, the very first thing you got to do is you got to build a cash protection for you. The second thing you want to do is you want to have cash for opportunities. I can tell you that every downturn in the history of time has created more opportunities than really anything else. When the 2020 pandemic hit, stocks were crashing and many people were freaking out, but it also created an amazing investment opportunity for the people that were financially educated, meaning prepared, that had money and knew what to buy. That's the second part of financial education, which is knowing what assets to actually purchase. But you have to have money to be able to actually take advantage of an investment opportunity, because you can have all the financial education in the world. You can see an amazing investment opportunity, but if you don't have any money to buy it, that doesn't do you any good. So the very first order of operations is to get your finances in order, stop spending all of your money, and have some cash, number 1, to protect you, and number 2, to be able to capitalize on opportunities. The second part of being financially educated means understanding how to invest your money. There are so many ways for you to invest, and you don't have to wait for a bad thing to happen to start investing your money. In fact, that's probably not the right way for the majority of people to start investing. What you want to do is understand, what is your investing strategy? Are you going to invest in index funds, mutual funds, individual stocks, real estate? How are you going to be investing your money? What we know is that 3 asset classes have built more wealth than anything else in the last century: stocks, real estate, and businesses. Now, if you understand that, you need money to go out and invest in these things. If you have a job, you have a business, you make money, don't spend all of your money, take some of the money that you don't spend and invest it into these assets. And then you can dig deeper into, do you want to be more of an active investor? Do you want to be more of a passive investor? This is what your financial education is all about, and I have a ton of videos on my channel where I go over how to do that. Second thing you want to understand is the financial news. And that probably means something a little bit different than what you're thinking, because when most people look at the news, they're reading what's happening on Reddit, they're reading what's happening on CNBC, and then they get all emotional. Oh, the markets are gonna never go down, I'm gonna buy this stock right now, or the markets are crashing, I have to get out before the world ends. This is how traditional media works. But what I want you to understand is the news just gives you a pulse of what's happening, but it should not dictate your investing decisions. No smart investment decision is made out of panic. No smart investment decision is made out of fear. You want to be making investment decisions based off of ration, not out of excitement, not out of fear. Just understand what's happening. That way you can stay in the loop of what's happening in the economy. What's even more important than that is keeping up to date with what's happening in the financial trends, because that's going to help dictate where you actually invest your money. Your financial education shows you how to analyze an investment. If you want to invest in stocks, it shows you how do you differentiate a good stock versus a bad stock, what is a profitable company versus an unprofitable company, which company has growing revenues versus falling revenues. That's your financial education. The trends show you, what industry do you want to be investing in? Do you want to be investing in brick and mortar companies, or do you want to be investing in companies that are investing online on the internet? And this is where what you want to look at is the flow of money. You want to look at how money and how consumer trends and how behaviors are changing in our economy to help dictate investment decisions. Now, there's a lot of resources out there. We do cover this in our Market Briefs Pro newsletter, but this is where I want you to start investing your time and energy into learning about what's happening in the financial world. That way you can find opportunities, because the reality is most people panic or they freak out or they get scared. But you want to be financially educated, so number 1, you can take care of your finances, but then number 2, you can capitalize on opportunities that come your way. But the only way that you can do that is if you have the financial education. You understand the news and you understand the financial trends that are happening. That way you can use an opportunity as a way to build wealth instead of just as a way to freak out and be fearful. Now, of course, we keep you up to date on Market Briefs. If you haven't joined that, I got the link for you down in the description. But if you got some value out of this video, please hit that thumbs up button, hit the subscribe button, and share this video with somebody who you think will love this video or somebody who you think will hate this video. A simple and basic way to understand if a company that you're thinking about investing in is overvalued or undervalued is by comparing these numbers from one company to another within the same industry. So what I want to do for the purposes of this video is I'm going to compare McDonald's, I'm going to compare Chipotle, and I'm going to compare Yum Brands. So let's start with McDonald's.